now by business reporter or editor rather, Xolani Mbanjwa, to look at what to expect in the first MPC meeting of 2022. So the markets seem to have priced in an interest rate hike. Why?
Well, it's what's happening all over the world. If you look at Central America, North America, Eastern Europe, all the emerging economies which are part of South Africa, if you look at how emerging economies are put together, they are all in a hiking cycle. Just yesterday, the U.S. Federal Reserve announced that they are going to hike interest rates in March. So it's because of inflation. We've seen inflation in South Africa rising over the past couple of months, which is not a South African phenomenon only. It's a global phenomenon. Due to the recovery in economies around the world, demand has actually picked up. Supply constraints have hurt that demand. And that means when it comes to inflation, the cost of living is going higher. And what we have to do in terms of the South African Reserve Bank, they have to follow what other countries like New Zealand are doing in hiking interest rates. We've enjoyed the lowest interest rates in the past 2 years. So this has been expected since we've heard in the previous MPC meetings that indeed we are going to see at least one 25 basis point hike every quarter in 2022.
So we're not the exception to the rule, really.
Absolutely not.
But we are expecting a GDP forecast. Why is that important?
That's very important because the Reserve Bank, along with National Treasury and other bodies like the World Bank, IMF, they give us a GDP forecast in terms of how this particular year is expected to pan out. You can imagine that we're still waiting for the full year 2021 in terms of looking at how the economy has actually done well, but it's actually an important measure in that everybody actually looks at when it comes to how they are going to perform. And if you look at that particular graphic, it actually shows just how from 7.5% in February 2020, COVID-19 comes into the country. A month later, in April, we saw that huge drop in interest rates, and this basically means that people have saved billions of rands due to the low interest rates. For example, a person who's paying a mortgage of 2 million rands was actually saving 3,800 a month just on the interest rate cut. So that tightening cycle that most central banks around the world actually went into because of the uncertainties of COVID-19 in 2020, things have got to change now. The picture is different. We are all in recovery mode. Now, consumers are going to feel it in the pocket, South African consumers in particular.
Not to judge, what did you do with that little bit of extra income? You know, treat yourself, why not? Let's take a look at some of the salient points that came out from November's address by the governor.
There are a number of them, and the most important one that we have to look at is, of course, inflation. And they spoke about how inflation is going to determine the movement. And if you look at inflation and how it's actually growing around the world, it's no surprise that we are here today. Another issue is the rise in crude oil prices. That has actually made sure that countries like South Africa, which are net importers of oil, are actually paying more and more. That exchange weakness when it comes to the rand versus major currencies is still there. So these are some of the things that are going to be important. Of course, looking at unemployment, the rise in other services and goods when it comes to inflation is actually very important. Another thing is the rise in the petrol price. In South Africa, we've seen a huge rise in the petrol price, now teetering on 20 rands per litre. Next week, we can expect more than 1 rand increase in the petrol price. So South African households are clearly under pressure, but I don't think, at least the market doesn't think, that is reason enough to actually not fire the trigger, although last year, the market thought that the central bank fired the trigger on increasing interest rates by 25 basis points prematurely. This time around, everybody's around the world, our peers are raising interest rates, and they are worried about the same thing. They are worried about supply chain constraints that have been brought on by things such as the chip availability for certain electronics and cars. That has been a huge issue. But looking at today's speech, GDP forecast is going to be important, inflation outlook is going to be important, as well as what's happening in the crude oil price and how they see it panning out in the near term.
Should we be following what the rest of the world is doing, just taking a look at the unique set of circumstances that we have? You speak of the strain on consumers. From the data sets that we are seeing, what is the situation with South African households and what to expect in terms of what this announcement will mean?
We are not living in an island, you know. We borrow from the same markets, and this is what I like about it is that this should not be a surprise. The market has already priced in a rate hike from today, 25 basis point rate hike. And if that is the case, it means in 2023, we are still not going to be back to those levels that we saw of 7.5% repo rate. It still means that we are still in a safe zone, but we are not alone, absolutely.
We're never alone. Xolani Mbanja, thank you very much to our business editor for helping us make sense and what to look forward to in the next couple of minutes when that announcement is made.